Stay away from flavor of the season. This is the lesson that many European banks are learning from lending heavily to sectors and markets such as the emerging markets, which are heavily dependent on energy, on metals, on mining, which are currently going through a severe downturn. Now, let's take some of the European banks which have lent heavily to these emerging markets. Standard Chartered Bank, or Stan Chart as they call it, has a very heavy exposure of almost 29% of its total loans goes to these sectors of metals, mining, and energy, which are all going through a downturn. Out of the $69 billion of exposure to emerging markets, $31 billion comes from exposure to countries like such as India, and it has lent for its infrastructure development. Now, the companies to which Stanchart has lent are in the infrastructure space. That means they have built infrastructure for the government, but government has still not paid them for the development that they have undertaken. Therefore, they are unable to return the money back to its bankers, and the European banks naturally suffer in the bargain. The lesson being that you to be careful and understand the business cycles and how they turn. As a consequence, you find that many of the European banks are reeling under pressure for investing in emerging markets when they were the flavor of the season. And they also lent very heavily. For example, Standard Chartered lent very heavily to China, almost $81 billion under collateral of property, which means property was kept as a collateral to give all these loans to various borrowers in China. Now, China, as you know, has been slowing down quite dramatically, and therefore, these European banks are finding it extremely difficult to recover these loans from China because even the collateral, the property values have been falling quite dramatically. And as a consequence, you find that many of these European banks are now beginning to tighten the screws, and they are beginning to reduce the exposure to sectors which are going through a downturn, such as metals, mining, and also to countries which have a very high exposure to these arenas. As a consequence of which, you find that the flavor of the season is now letting itself weigh to being an area where people do not lend anymore. And this, I think, would be exactly the mistake which many lenders do. Whenever they see that there is some business which is doing extremely well, they begin lending to that sector. And when it goes to a downturn, they just move out. Now, how do you know? These areas which they are backing out from may be the very areas which could be going through a very quick upturn now. And in which case they would be very much flawed in taking money out of that sector, because if these sectors go through an upturn, then and or they begin to look up, then these would be the sectors that would be the most profitable to lend money to. So they could be making a very serious mistake in not being able to understand the economic cycles as they turn. And this is the biggest blunder that banks which lend make, not being able to understand the turns in the economic cycles. This is the entire business of banking is not based on what is the flavor of the season, but what is going to turn next. You need to understand that to be able to make wise lending decisions. And I'm going to point out what's the next economic cycle turn that is going to take place very soon. In the meanwhile, you would have seen that emerging market stocks have suffered a little bit because of the rise in the dollar and the fall on their own local currency. Now, this all is because of the slowdown that has taken place in emerging markets in various parts of the world. And not to say that their valuations are any cheaper. In countries like India, you would not believe, but at something like 25 times trailing earnings of the last 4 quarters is about is almost equivalent to the levels that were uh, there during the 2007 great financial crisis, which means that it is just the multiple expansion which has brought about the rise in the stock markets, and not the earnings growth which has brought about. The true growth in stock multiple should come from the earnings growth and not just from multiple expansion. And multiples have already expanded. So what is the outlook from here? You'd find that not only the valuations are very rich, but there is also another surprising trend which is existing, that the countries such as India are at the from the business cycle perspective, they are at the levels which they were during 2000. But as far as stock market valuations are concerned, they are at 2007 levels. This is a great anomaly which needs to be corrected, and the stock markets are going to reflect that very soon. So do take that into consideration while you consider investing in these markets. Who has lent to whom, what how the valuations stand. In fact, this may be a very good opportunity for distressed debt companies to take advantage of the scenario and make quick money in this situation. So happy investing. Take care.